What if the price signal everyone has been waiting for didn't come from Wall Street, didn't come from COMEX, and didn't come from a headline screaming silver to the moon, but instead quietly slipped out of one of the most trusted physical bullion institutions in the world? Imagine hearing that the Perth Mint just quoted $127, not as a futures price, not as a speculative chart, but as a real-world signal tied to physical availability, delivery stress, and vault behavior. If that sounds unbelievable, that's exactly why it matters. Because moments like this don't show up at the top of a bubble, they show up when the plumbing of the system starts to crack. To understand why a quote like this is sending shockwaves through precious metal circles, you need to understand what the Perth Mint represents. This is not a fringe dealer, not an online seller chasing clicks. The Perth Mint is a government-owned institution in Western Australia with a history going back more than a century. It refines gold and silver, operates one of the largest physical bullion programs on the planet, and is deeply integrated into global supply chains. When something unusual appears in a Perth Mint quote, professionals pay attention, because this is where paper promises meet physical reality. Now let's slow this down, because the number $127 is already being misunderstood. This is not a new global spot price flashing across your screen. This is not the COMEX price suddenly leaping overnight. What's being discussed is a quoted price tied to physical silver under extreme conditions, reflecting availability, delivery timing, and vault stress. In other words, it's a signal, not a headline. And in precious metals, signals often matter more than spot prices, because spot prices are financial abstractions, while physical quotes tell you what metal actually costs when the system is under pressure. Think of it like this. Spot price is the menu price. Physical availability is whether the kitchen actually has the ingredients. When supply chains are smooth, the two stay close. When supply chains fracture, the menu price becomes meaningless. That's when premiums explode, delivery times stretch, and suddenly you hear numbers that sound impossible compared to what's on a chart. That's what makes this Perth Mint quote so important. It suggests that under certain conditions, silver is already being repriced far above the paper market. This is where Shanghai comes in, because this did not come out of nowhere. For months, people watching physical flows have been pointing to the Shanghai Gold Exchange as an early warning system. Shanghai trades physical metal, not leveraged paper contracts. When prices in Shanghai diverge from Western markets, it usually means physical demand is overwhelming supply locally. That divergence has been growing. Premiums have been persistent. Metal has been flowing east. And many analysts said, watch Shanghai, because when the stress goes global, the West will feel it next. Western vaults breaking is not a metaphor. It refers to the growing evidence that large bullion banks, ETFs, and custodial vaults are struggling to meet delivery demands without rehypothecation, delays, or sourcing metal at higher and higher costs. When metal is plentiful, delivery is boring. When metal is scarce, delivery becomes negotiable. Cash settlement offers appear. Substitutions are proposed. Time extensions become normal. These are not signs of collapse, but they are signs of strain, and strain is what causes repricing events. Historically, silver has always behaved this way under stress. In 1980, during the Hunt Brothers episode, the paper price surged, but the real panic happened when physical silver vanished from the market. Dealers closed their doors. Premiums went vertical. In 2011, during the post-financial crisis rally, the spot price approached $50, but physical shortages appeared even before that peak. What most people forget is that adjusted for inflation, those prices are already far higher in today's dollars. A $127 physical quote sounds extreme only if you assume the system is functioning normally. Now let's talk fundamentals, because hype without fundamentals goes nowhere. Global silver mine production has been flat to declining for years. New discoveries are rare. Ore grades are falling. Most silver is produced as a byproduct of other metals, which means supply does not respond quickly to higher prices. At the same time, industrial demand keeps growing. Solar panels consume enormous amounts of silver. Electric vehicles, power grids, electronics, and batteries all rely on silver's unmatched conductivity. Unlike gold, silver is consumed. Much of it is not economically recyclable at current prices. Once it's used, it's gone. On top of that, investment demand has returned quietly but steadily. Not speculative futures positions, but physical bars, coins, and vault allocations. When investors lose confidence in currencies, debt, or political stability, they don't rush into silver because it's exciting. They rush because it's tangible. Silver has no counterparty risk. It doesn't depend on a promise being kept. And that matters more when trust is eroding. So what does a Perth Mint quote at $127 actually confirm? It confirms that under certain stress conditions, physical silver is already trading in a different universe than paper silver. It confirms that Shanghai was not an anomaly, but an early signal. It confirms that Western vaults are not infinite reservoirs, but inventories with limits. And it confirms that the idea of silver being abundant is increasingly disconnected from reality. Here's an analogy that makes this easier to grasp. Imagine a dam holding back water. The water level rises slowly, almost invisibly. Most people look at the gauge downstream and see calm flow. But engineers watching the dam wall see pressure building. Small cracks form. Nothing dramatic happens at first. Then one day, the price of holding water back is higher than letting it flow. Silver pricing works the same way. The paper market smooths volatility until it can't. Then repricing happens in steps, not increments. This doesn't mean silver is guaranteed to trade at $127 tomorrow. It means that the market has already shown you what silver costs when delivery matters more than contracts. That distinction is everything. And once that line is crossed, it's very hard to uncross, because confidence doesn't return overnight. Once buyers believe metal may not be there when promised, they demand more metal, faster delivery, and higher premiums. That feedback loop is what turns warnings into confirmation. And that brings us to the most important question going forward. If physical silver is already being quoted at levels that dwarf the paper price under stress, what happens when that stress spreads, when more investors demand delivery, when industrial users panic buy, and when vaults can no longer smooth the gap? In the next part, we're going to connect these dots directly to COMEX inventories, ETF flows, industrial demand pressure, and why the gap between paper and physical could become the story of the decade, because